The broadcast is now starting. All attendees are in listen-only mode.
Welcome, everybody. My name is Megan Cox, and I'm the Event Marketing Manager at Curinos. Thanks for joining us for today's webinar, How to Win in Small Business. As the industry's leading provider of data, analytics, and technologies, we are here to help you better attract, retain, and grow profitable customer relationships for your financial institution. If you have any questions during the presentation, please type them into the question box in your GoToWebinar control panel. This webinar is being recorded, and we will send the recording and the deck via email tomorrow morning. Okay, Adam and Olivia, let's begin.
Thanks so much, Megan. So we'll just start with, we probably know most of you at this point, but just introducing quickly who is Curinos and what do we do in the small business space. Curinos provides data, technology, and insight across nearly all bank verticals. And specifically within small business, we collect data from a majority of the market on both on deposits, on loans, on digital journeys. We do proprietary customer research and help a number of clients strategically with their small business priorities. You'll be seeing data from all of those sources as we go through our presentation today. As Megan mentioned, please do jump in and ask questions as we're going through. Just to introduce ourselves as well, my name is Adam Stockton. I oversee all of our retail deposit and lending businesses. So not only small business, but also consumer and wealth, giving me a kind of cross retail view of the end customer across our deposit and lending data, software platforms, and strategic advice. Olivia?
Hi everyone, Olivia here. I oversee our product and value proposition strategy practice, very much focused on go-to-market, whether it means and how does it translate from a go-to-market perspective, whether it means digital experiences in operating model from a branch perspective, all the way through kind of what do you need to put on the shelf to actually really win within the space.
Awesome. So what we'll go through today is a brief state of the industry. Where are we? It's been now 4.5 years of a really dramatic upheaval across the financial services industry, but in particular within small business because of the dramatic impacts on small businesses themselves. So where do we stand today? And then we'll really spend the bulk of the time, as the title of the webinar promised, on 4 key themes to win. So what do you need to do to get ahead in this environment? There's a continued focus on deposits. So how do you grow and retain deposits without increasing your cost, particularly given the Fed news from yesterday? Number 2 is, and it really links closely to number 1, one of the ways to grow deposits is by standing out in the marketplace. We're moving beyond the place where, you know, it's all that matters is do your RMs have the right relationships in their communities. Not saying that's not important, still absolutely important and one way to win. But with shifting customer preferences as small businesses are going more digital, want to see their financial institutions, their bankers less, there are more opportunities to innovate and stand out from the crowd. We would be remiss if we didn't talk about credit. And an environment where we've started to see delinquencies come up. You know, how do you think about using credit relationships to grow broader primary relationships that are going to provide sticky value regardless of rate environment? And then close out with, you know, how do you use data to drive all of these decisions? So jumping in, we will start with, you know, where we are from a deposit perspective. You know, one of the big themes of the last 2 years has been, you know, that small business leaders across banks and credit unions have had to think a whole lot more about deposits than they ever did in the past. Many small business bankers viewed themselves as lenders who, sure, we like to get deposits along with it, but we're not really focused on that. Given the market the last couple of years, that's changed pretty dramatically to deposits being a huge focus of nearly every institution we talk to from a small business perspective. So where are we? As rates went up, small business deposits really started to run off pretty significantly. You can see, particularly kind of midway through last year, we started to see some of that runoff steepen. The dashed gray line here in the middle is the industry average. We also look at top performers and bottom performers. So what's that dispersion of, hey, what does good look like? Interestingly, through most of last year, good was looking like growth while most of the industry was declining. Even that's now turned around a bit to where even the top performers have seen a couple points of runoff year to date. Meanwhile, in the bottom half, those institutions were seeing 10 points of runoff through the end of last year, and another 8 points or so of runoff this year. The good news is that the runoff has really started to level out a little bit. We see some risk for kind of continued runoff on the horizon, but not at the same pace as what we were seeing, through kind of last year and first quarter this year. The other side of that is the cost side. So as the Fed has increased and deposit costs have gone up across all segments, small business has gotten a lot more focus from treasurers and CFOs around the industry, because small business deposit costs, and this has been true for the last 20 years, small business deposit costs are dramatically lower than other segments. The first thing you'll look at on the left here is those blue dots, which are what is the average interest expense or portfolio rate paid in each of those segments. Small business is sitting down at 136 basis points compared to 195 for consumer, and 275 to 334 in commercial and corporate banking. So still a substantial cost advantage with the deposits that you have on the book. Interestingly, though, to bring in a new small business deposit dollar, you're not paying 136 basis points. You're paying 310 basis points on average. And that's weighted across all products. That's even considering, there's a DDA mix of 64%, as you can see on the right-hand side, which means the new deposits coming in the door are less mixed towards DDA than the existing deposits on the book, and you're having to pay significantly higher rates for those deposits than the existing deposits that you have. This is one of the core conundrums that nearly all of our clients are facing in the small business space, is CFOs and treasurers are paying much more attention to those blue dots than they are the bars. And they're saying, hey, your deposit cost is much lower than my cost in these other lines of business. Get me more of it. Bring in more of those 136 basis point deposits. And it's not that simple. If you're kind of using rate and pulling in some of the MMDA wallet along with it, or even increasingly, which we didn't expect to be saying, CDs, you're paying a lot more. Olivia will talk about, as she goes through as well, bringing in new DDA relationships is getting a lot more competitive and more expensive as well. And so growing what is a long-term, really attractive segment is a whole lot more expensive in the short term than it is in the long term. On the credit side, you know, we've seen a pretty meaningful tightening. You know, so what we're looking at here is the demand, which we measure as application volume through our lenders benchmark consortium. You know, we get kind of both applications and bookings from a number of the largest players in the market, as well as a number of smaller regionals, community banks, and credit unions, as compared to the supply, which is the booked volume. We've seen demand continuously outpacing supply for the last couple of years. As many financial institutions have tightened up the buy box, anticipating kind of potential economic tightening. You know, and so there's more need out there from small businesses for credit than banks are willing to give. That presents a huge opportunity, you know, because kind of one of the things that we've seen historically is credit relationships drive primacy, and they drive deposits ultimately. Small businesses are tremendously loyal to the financial institution that first gives them credit, because that can be the difference between making it as a small business and not making it as a small business. So, you know, even as risk is understandably becoming a bigger priority for many financial institutions, you know, kind of understanding also that long-term value and the value of the primacy is important. On the topic of primacy, you know, maybe Olivia, you want to talk for just a couple minutes about kind of how we think about primacy and DDA relationships, and you know, what are the trends we're seeing there?
Yeah, just really quick on that front, and we'll dive into it a little bit when we think about value proposition and the purpose of value proposition within this space. Primacy as a whole is still very much tied to that operating account. And so when we actually ask whatever segment they're in, whether they're micro businesses, 1 to 3 million, 3 million up, it's still very much, it's wherever my main checking DDA account is. And hence that relationship then becomes extremely valuable in order for us to capture the rest of it. Now, this question around the lending aspect too, in terms of how that comes into play, we do tend to see that we're able to actually provide more holistic proposition, holistic offerings in terms of a lending arm in conjunction with a very productive, very constructive type of product, or on the DDA side, then we're able to build a pretty solid proposition to go to market with. And that drives a bit more primacy and stickier relationships.
Yeah, on the stickier relationship side, I would just point out the graph on the right-hand side. Small business deposit retention, where you have that primary DDA anchored relationship, is really strong. You know, so if you can get that primacy, if you can get the payments, treasury management to the extent that there are needs in some of the larger small business segments, you're likely to keep those deposits around for a longer period of time. So again, that kind of long-term, sticky, really valuable deposit relationship that your treasurers and CFOs are asking you about. You know, but it's the bringing it in the door and getting that primacy in the first place that's more expensive. Oh, you're muted, Olivia.
Yeah, so in this particular slide then, exactly what Adam had kind of been referencing earlier is that a lot of things have changed for small businesses, especially coming out of the pandemic, right? When we think about what the demand attributes are and what are most important to small businesses, we see a massive decline in convenient locations. And so it doesn't mean that branches go away. It doesn't mean that RMs or bankers go away. It just tells us that these factors, these levers, are become a little less important relative to then superior products and services. So do you have the right products and proposition that actually fits my business's needs? And then advice. This is something that folks have always talked about, but it's really hard to give advice to small businesses in a scaled manner. And that's also most relevant to that particular small business. And so, but these are the two two factors that continue to actually go up, and we do see very major opportunities within the product innovation space as well as the operating model space then in terms of what type of engagement and what is the nature of that engagement with small businesses in order for us to drive higher acquisition and more meaningful relationships over time. And so this is where then, because of this factor, we see on the right-hand side some major shifts from a non-bank growth perspective, right? This is where we start seeing a bit more awareness as well as openness to actually working with non-traditional institutions like fintech providers. And a lot of these fintech providers are hitting spots where they are not hitting spots where traditional institutions have not historically provided. Very convenient payment options overall, and or cash flow options and analyzer options. And the last but not least, the lending piece, right? If I go to a traditional FI, I might not be getting the lending needs, or I might not be getting my lending needs met in a timely manner. They're going elsewhere. And so what we're seeing here then, given it's not about convenient locations anymore and about services and products, then the propositions from a lot of fintechs and DTB types of FI providers then start coming up and have a much higher likelihood then to actually disrupt the space.
You know, one of the other ways that I think about this chart on the left, and I want to be clear, you know, despite the fact that we didn't invite our network planning expert to join the call, you know, it's locations are less important, but they're still important, as are RMs. And in particular, as I think about how you provide that advice, you know, there's a real opportunity for more traditional FIs to lean into a multi-channel point of view. Some businesses, as you can see on the right, are comfortable with completely digital sources of advice. A majority are not. And so they need a digital component. You know, I've heard you before, Olivia, kind of state the need for advice as a yes everything model, where they're looking for advice from their communities, from their friends, from fellow business owners. They're looking for advice from online sources and articles and media and influencers, and they're looking for advice from a trusted financial advisor in their financial institution. And so, you know, it's in many ways, I think of a small business as going through many of the same shifts we saw consumer go through 10 plus years ago, where, you know, branches are important not for day-to-day transactions anymore. Instead, they're important for getting advice as my needs change, as I'm going through a different stage in my business. You know, and so it's not, hey, get in and out the door of the branch in 5 minutes. It's, I need to sit down with somebody for an hour and really discuss the fact that, you know, I'm trying to transition my business into a different phase, and my needs are changing, and how can you help me through that?
And that it's a really good point, Adam, because it's about evolving then, right? It's not about getting rid of, it's not necessarily, you know, how do I cull our network of bankers and distribution, our branches. It's actually about how do you evolve what our branches and what our bankers are going to offer. So that tells us that we're not necessarily in the game of servicing. There will be, of course, a servicing component, but how do we turn up the aspect of partnership? So do we have the right folks in place in terms of having the expertise that's specific to the particular industries or to that community overall? Do we have very strong we have specific expertise in scaling companies? Like in the example that Adam brought up, if you're a micro business, you're about to hit your first million, are there things that we can actually proactively provide that is more holistic? And that advice though could come through your network today, bankers and physical distribution branches, as well as then in conjunction to that, the role of digital. So how does that ecosystem kind of really evolve into the next phase?
Awesome. So with that, we'll dive deeper into those 4 opportunities that we identified. You know, first, really thinking about, hey, deposits continue to be important, continue to be a focus of a majority of the FIs that we work with. but how do you grow deposits and how do you retain the deposits you have? Not only without increasing the cost, but given the 50 basis point news from the Fed yesterday, I'd be surprised if you haven't already been asked by your CFO, how can we reduce the cost of what we have? And by the way, I'd still like you to be growing instead of shrinking. So, we shared a slightly different view of this earlier, but, small business deposits remain attractive in large part that super strong mix of DDA. This is much higher DDA mix than we see on the consumer side. It's also much higher DDA mix than we see on the middle market and large corporate side. In both consumer and large corporate, you have much more, investable cash that is kind of sitting around not for my day-to-day needs, but for the long term. Whereas many small businesses, are kind of working day to day, and all of my cash is kind of working capital to run the business. The challenge we've seen though is that, as small business deposits have run off overall, almost all of that runoff has come out of DDA. And what's come in to replace it has been rate-driven deposits instead. Now, a lot of that is remixing, because look, for a small business, even if they would prefer to think of it as working capital, if a small business has a couple $100,000 of cash sitting around, when rates were at 0 or 1%, it really didn't make sense to optimize. A small business owner does not, and particularly as we're down in the kind of sole prop and micro business space, a small business owner wants to spend as little time thinking about their finances and their banking relationship as possible, and as much time as possible thinking about how to grow the business. As we got up to 4 and 5% rates, though, the attractiveness of earning some yield on that free cash really started to outweigh the not wanting to think about my banking. And so even as DDA ran off 20 points last year, we saw significant growth in MMDA and CDs, as a lot of those deposit balances remixed. This is even more true for newly acquired deposits than it is for existing deposits. When a small business is changing their banking relationship and moving to a new provider, they are much more thoughtful, driven both by the business as well as the bankers at the new institution about optimizing their relationship. And so, if a business has $500,000 in cash, they are, when they open a new banking relationship, going to be putting a more significant chunk of that into rate-driven deposits. Whereas, existing customers definitely moving, but moving a bit more slowly. On the cost side, and you can see these graphs are not to scale. That graph on the left would be, none of those bars would be visible. Look, even as we've seen a little bit of IB, DDA, and hybrid DDA coming into the small business space, and so those rates are not 0. They're pretty close to 0. The average savings rate, has now for kind of well over a year been over 250 basis points, and the average CD 450 basis points. So it's created a real barbell effect within small business deposits, where a small portion, about a quarter of deposits, are priced really high. And then 75% of deposits are earning very little. As you think about down pricing, that also presents a challenge when your CFO comes and asks you, hey, the Fed went down 50 basis points. Your costs are going to go down 50 basis points, right? And the answer is no, they're not. Those CD volumes are locked in. for another, 6 to 8 months on average. And given that 75% of our deposits are earning under 25 basis points, that would mean we need to drop those savings and MMDA rates by 200 basis points to see anything like a 50 basis point decrease. So the kind of cost savings on the way down are limited by the slower pace of increases on the way up. One of the cool things that we're able to do with our small business deposit analyzer data, which is this is our deposit benchmarking consortium, where all of this deposit data has come from. It's monthly data built up from the account and customer level. Is kind of breakout differences, though, in the different segments of small business. And in particular, in small business, we've seen very different behaviors by business size. Most interestingly here, you can see in the smallest businesses, under 250,000, we've seen much lower average rates. And a big part of that is much higher DDA mix, right? If your deposit balances are low, it doesn't make sense to put it in other products. So really attractive from a rate perspective, but that's also where we've seen the most runoff. Those are the businesses that are living more at the edge. They tend to be less established businesses. More need for those deposits to be deployed actively. Higher failure rates in those businesses. Where you tend to see more stability is in the higher end of small business. That's also where you see higher costs. So there's a trade-off here as well in terms of who you're going after and trying to target, versus the cost of keeping those clients. One of the interesting views we see here is, again, kind of there's a big difference between what's already sitting on the book and what is coming in new to bank. I mentioned before, and I've shown a couple slides, over 60% of existing small business deposits are in DDA. But when you look at that left-hand graph, this is acquisition. So this is new to bank dollars in this particular month. You can see the DDA mix is sitting under 30%, whereas MMDA and CDs make up over 60%. So that ratio flips for new to bank money. That new customer that you're attracting into your institution, instead of being 60% DDA and 40% rate based, is 30% DDA, 70% rate based. And on the right hand side, you can see what those rates are. Over 400 basis points. Almost a quarter are over 500 basis points. And so yes, the DDA balances are still coming in at zero, but that barbell that I was talking about is particularly extreme on those new customers, where a third is coming in at zero, half is coming in at 400 plus, and very little is coming in the middle. So what does that mean as we think about going forward? It really means, you have to be thinking about how are you going to manage those different components of your book? How do you think about the savings and money market balances, whether you're using rate sheet pricing, promo pricing, exception pricing? How can we find the segments of businesses, that are more rate sensitive versus less rate sensitive, where you can kind of confidently bring down some of those balances by the full 50 basis points that the Fed dropped, and others that you might need to manage down more carefully. It's in many ways an easier conversation when somebody has an exception rate all the way up at 5%. Hey, if they got indexed to Fed on the way up, you can probably index them to Fed on the way down. But what if they're sitting at 300, 400 basis points today? Some of those are going to be much more difficult conversations, and understanding those underlying customer behaviors and being able to scenario plan for them is really important. From a CD perspective, most institutions don't really have the history or the muscle memory when it comes to using CDs in the business space. Most business owners don't have that muscle memory either. Even in prior rising rate environments, we saw consumer deposits go into CDs, but not business deposits to this extent. So what are you doing from a customer and client messaging perspective? What are you doing from an RM messaging perspective to deal with these renewing balances, understand whether they still need rate or they should be in some other deposit vehicle, and then scenario planning for all of it. My personal bet was that the Fed was only going to go down 25 basis points. But you can believe, as we looked at our kind of internal analytics, we ran a 50 basis point scenario. You need to be as well. You need to have a proactive playbook for what happens if there's only one more 25 basis point decrease this year. You need to have a playbook for what if there are two more 50 basis point decreases this year. You need to have a playbook for the level of growth that you're being asked to get versus not. So, planning for how you're going to do that and really communicating through the organization on a realistic view of what those costs are going to be. We want more of those 160 basis point deposits, but it's going to cost a lot more than that to bring them in. And getting that data out in front of your executive leadership and your finance and treasury organizations so you can be making the right decisions, absolutely crucial. So let's pivot over into, all right, that was the rate-based side. More important in a lot of ways for growing those long-term stable deposits is those primary anchor DDA relationships, and how you need to be thinking about those differently than you ever have in the past. We can't hear you, Olivia. I still can't. Technology challenges. Megan, I assume it's not just me and you can't hear Olivia either.
That's correct. Try again,
Okay.
Olivia. I think I just heard you.
You did?
Yes.
Yep.
Okay,
Now we got you.
Yeah. Okay. Is it clear? I just want to make sure.
Yeah,
Okay. Perfect.
good.
Thank you. Apologies for that. So as we dive into the value proposition and operating model aspects, right, a big piece of this is trying to figure out if you, certainly as Adam talked to, how do you really elongate? How do you make those relationships stickier? How do you ensure retention and deepening? The other aspect of this is how do you continue to grow the franchise and win a lot of those operating accounts that could be floating and or switching within the marketplace? We walked through this chart earlier in terms of what are the biggest and most important attributes moving forward. Advice, superior products and services certainly are continue to be most important, and we have to think about evolving what the operating model is going to look like moving forward. In this environment, on the next slide, we know that then this gives us a sense of who is actually able to be differentiated within the marketplace. On the left-hand side, there's a pretty strong relationship between your level of distinctiveness or your ability to be differentiated within the marketplace relative to what is your share of banking relationships within this space. And so you can see, you get a sense that there are maybe a handful of more traditional institutions, and I would say who have a scaled play, who are really reaching that distinctiveness point, right? Their voices out there, they have the largest voices, they have the largest networks out there, which could make sense from us. You can differentiate through scale. And then you see a lot of other more direct though players who either are focused on the lending side or the payments aspect. So the two major pain points that businesses tend to see historically with traditional banks overall. What has shaped this then, the shifts in demands have shaped really the different players that have emerged within the space. You see on the right-hand side then, the level of bank awareness or institution awareness, I should say, between 2018 versus 2023 today is that a lot of the bank awareness lift has really been in the fintech space, or folks who are really direct to businesses, like the PayPals of the world, Squares, Googles, etc. They're the ones actually getting more association around, we offer services within this business space. And the fascinating thing is that when we ask small business owners or business owners overall, would you actually switch your operating account to them if they had that, if they had a holistic offering? And the overwhelming answer is yes. It's about 60 to 70% of those people who actually have a secondary relationship with these fintechs. That's the scary part. That's the point of disruption that's really facing us, and that from a value proposition perspective, we have to really rethink how we go to market. And hence, on the next slide then, given that context, shifting demands as well as shifting competitiveness, we do see then different, of course, small business models, but the two that are emerging more or less are a pure product play, meaning can I go to market with a very specific product proposition that's differentiated from that perspective, or can I go in with something that's more of a segment play? So instead of, and this is not to say, this is maybe a method that everyone had gone to market with in the past, is that every bank will go in with the mindset of, well, we should serve, and we should serve everyone. Absolutely, you should serve and serve everyone. But when we build in terms of building propositions, can we be more targeted in who we want to build for, so that we build a sense of higher levels of differentiation as well as distinctiveness? And so that's a piece where two of the hypotheses in terms of, if you're not a scaled player, so all the way to the right here on this slide, and you don't have unlimited amount of marketing, unlimited product dollars, unlimited franchise dollars, then one of the big plays here is really to figure out how to narrow and where to really put more dollars against, and that's generally going to be within the first two buckets, if you will, of business models. So we'll talk about a couple of hypotheses then. So on the product play perspective, we see a really interesting opportunity in right-sizing, I would say, treasury management. Unfortunately, small businesses, our small business line of business had always been kind of fit into the retail space, but then also somewhat fit into the commercial space, or it'll bounce back and forth maybe every three or 4 years. The biggest issue there then is that means we, as an industry, from the traditional ad perspective, have not been able to actually tap into building products that are really relevant for small businesses. And so one of our big hypotheses here, and we don't even need to call it treasury management actually within the small business space, but that there are certain features and certain functions within the commercial TM space that can be very much right-sized and reshaped for small businesses, but positioned in a way that's actually quite differentiated, just because we haven't quite seen it come through yet. And cash flow and treasury management TM needs are extremely important within the space. And so we do think there's a very strong product proposition aspect that could be further explored.
Hey, Olivia, a question came into the Q&A, which, by the way,
Yeah.
thank you for the question, and please keep asking them. Go ahead and type them into the Q&A box. Is it that not having TM type services available is a pain point to a lot of small businesses, or is it that it's a very big pain point but for a smaller number of businesses?
Maybe it's a little bit of both, I want to say. So here's the thing. Here, I would say maybe it's a little, and the reason why I say a little bit of both, my first reaction is it's probably a little bit on the latter front, right? So there's a smaller number, quote unquote, of smaller businesses who kind of are hitting the higher revenue range that would be very beneficial to actually get TM types of features that actually fit within their business suite or business relationship with you. However, and this is where we haven't further explored what TM features could look like for some of the smaller businesses with under 5 million in revenue. I do think that's probably the biggest open white space that we actually need to go and explore. So TM as it stands today, definitely smaller group within small business. TM as it needs to stand tomorrow, and where we can actually defend and go on the offense, I should say, from a, defending our book from a fintech perspective, that's where we need to further explore. And that's why I actually say it might not be called TM in the future. It's actually exploring what those needs are and how some of those payment functions could actually drive value for our client. Is there another? Okay, good. On the another aspect of this, right, the segment play. When we think about small business, I think, and I even used this as an example earlier, it's under 1 million micro business, 1 to 5, and then 5 plus. Those are massive numbers of businesses. And those are not segments, to be clear. And so that's where we fully believe in de-averaging what that small business market looks like, whether it be by age of business, so by maturity. Someone who's just starting out or who is just about to scale will have very different needs than someone who's about to exit or was looking for an exit. And so there's that aspect. The other aspect is really, what is the purpose of that business within their personal ecosystem or their financial ecosystem as a whole? Some folks will, and some business owners will find that their business is completely part of their identity. They want to grow it. That's what they stand for, and that's what they're going to do with their purpose. Some folks really treat their small business as, hey, this is my income. I'm going to make sure that this income comes through and that I do the minimum that I need to do to actually continue to make it function. That's about it. That context in itself tells us that they're going to look for very different types of FIs and very different types of services and sources of advice. And so even giving you a sense of, and this is where we want to give you a little bit of a sense of, what does it look like for a business under 5 years of operation, so a younger business versus a business that's a little older, so over 5 years, to give you a sense of what the white spaces might look like. And the chart here you're looking at are really around the attribute association, meaning our territories that are quote unquote high appeal. So hopefully top half of this chart, and then versus attribute association, meaning do they see any FIs within the space actually delivering on any of these territories? The numbers then within that top left corner, the high appeal, low association bucket, look different between the under 5 years versus over 5 years. And so this is where the importance of understanding who you're really after is going to be helpful in helping us prioritize what parts or what territories we really want to differentiate in and invest in. So that's the other big hypothesis that we want to move forward with. And then the third point I'll make on the next slide is your operating model. Product and delivery need to change from an effective, just in order to create something that's effective, but also take into account cost to serve. This is just to provide an example of what the continuum could look like, but honestly, a lot of this could actually be redefined over time. So your typical branch, branch staff versus literally a small business banker, or someone in a centralized call center could all have very different functions depending on who you're really after and what segment you're really after. And so the people aspect of this is incredibly important. In fact, one of the things that doesn't actually stand out for as much in consumer versus small business is actually the community. Like, does my FI actually understand the community or the industry that I play in? That's something that doesn't necessarily, ring a bell or isn't necessarily common within the disruptor space. That is something that we can, from the traditional FI space, actually grab onto, right? And start evolving what that looks like across channels, but also across our different people and banking teams. And then last but not least, this all comes together with, what is your small business value proposition? If we want to grow in this space, and as Adam pointed to, this is a very lucrative space in terms of these are sticky deposits. There's a lot of unmet needs. Not a lot of folks have innovated in this space. There's a lot of opportunity to actually figure out what we actually stand for, and then build out the right people, branch network, as well as products in order to fit that mold and really go to market in a differentiated way.
Yeah, maybe I would just kind of underline this point in that, you know, even overall at the top of the house, if we go back 10 or 20 years, most regional and community banks didn't have a unique or distinctive or compelling value proposition at all. Nearly every bank I would go into 15 or 20 years ago said, hey, our value proposition is that we out-local the national banks and we out-national the banks that are smaller than us. And interestingly, that was true of kind of billion-dollar institutions who said, well, we're bigger and we have more scale than the tiny community banks. That was true of the $10 billion institutions, 50, 100, and even up into the $250 billion institutions. Because you can't compete purely on local market scale anymore as a bank, and haven't been able to in the consumer segment now for 10 or 15 years. You need something to set you apart. Why would a client choose you over all of your competitors? You know, in the small business segment, the vast majority of FIs we still talk to say, you know, well, it's because we're deeper in the local markets and we understand the communities and we understand the businesses. Again, that's still important. Olivia mentioned that earlier. You have to do that, and that can be part of a compelling value proposition going forward, is you will have more ability to do that than a fintech ever will. But it's not sufficient anymore. You need more. Because why would a new client choose you over anyone else, particularly some of the newer small businesses run by younger owners who don't want to interact with a bank in traditional banking hours anymore, who you know, maybe aren't as connected to the Rotary clubs and where the RMs are going. And so, you know, having these benefits and proof points that underline that can make a business owner feel like you are talking to them specifically, you understand their business and understand how to serve it, can be huge in terms of differentiating your ability to capture new businesses. So with that, a brief pivot into credit, just with some statistics coming from our lenders benchmark for small business platforms. We look at kind of across the spectrum at applications, originations, and portfolio as well to identify portfolio trends. A little bit of a deeper dive here into you know, the demand side and the supply side. You know, in terms of demand, relatively flat overall, with the exception of SBA, you know, where there's more significant demand overall. Interestingly, though, as we look at the supply side, there's still almost a complete mismatch. You know, banks are willing to do even more SBA than the demand that exists, and particularly on the line of credit side, you know, there's been a real tightening in terms of buy box and willingness to lend. You know, that opens up a couple opportunities. The first of those is margin, you know, where we've seen, you know, some margin improvement across the board as rates have risen, you know, particularly for businesses who, you know, need the credit or only part of the credit, or on the line of credit side, assume that, you know, they won't need it for the long term. You know, having the credit is often more important than exactly what the rate is. So, you know, margins have been able to expand, you know, particularly on the line of credit side over the last couple of years. But the other side of that is risk. You know, so looking at delinquency rates, you know, particularly for more recently booked lines, you know, we have started to see you know, a real increase. These kind of trends are what you'd always expect to see, right? I mean, you know, a 15 or 20-year-old line that has been used, you know, kind of appropriately by a business over that long period of time is always going to have lower risk than something that's booked more recently. You know, but we can really start to see, you know, that's where some of the risk is ticking up. There are opportunities to, you know, kind of continue to deliver credit at attractive margins and manage the risk in ways, again, that as you're looking for the deposit-rich, less rate-sensitive customers of the future, you know, the businesses that are going to continue to build that portfolio that's highly valuable, you know, credit has to be a piece, even in a more difficult environment. So wanted to just close out on the importance of data. We've already covered this page, but just a little more briefly into the two solutions. Having access to deposit data on a monthly basis that is tuned to your specific portfolio helps you understand where the market is going. Hey, we're down 15 points of DDA last year. Is it time to panic? And the answer is no, absolutely not time to panic. The market's down 20%. It's actually a huge win if you're only down 15 points in your DDA book last year. You know, and being able to use that to you know, kind of drive the strategy of what you're doing, understanding how that performance compares to market, understanding your actual cleared rates paid. So including exception pricing on the savings and money market book. What are new deposits actually coming in at? Being able to make the case. No, we can't acquire more balances at 160 basis points. We can acquire more balances, but those cost over 300. And bringing actual data behind that. You know, so the deposit space, also the lending space on again, both the originations and portfolio side, where are there opportunities from an industry perspective, a business size perspective, a geography perspective? You know, where is there unmet need? Where is there unmet need with margin and risk profiles that we're willing to take on? You know, and look, under the scenario that the Fed nails the soft landing and economy remains reasonably strong, we look like we're coming out of this without going into a recession. Being able to be out in front of where the market is going from a demand perspective is going to be really important. You know, kind of having these tools, having these data available, being able to do the scenario analysis and plan ahead so that you're ready to take advantage of the market conditions as they come is absolutely critical. So we hope the session today was helpful. As you can tell, we're passionate about the space. For any of you attending, we'll also be speaking at the American Banker Small Business Conference next month. It won't be a repeat of the same content, so come, you'll hear something new. If you're interested in getting a deeper dive into any of this data, into thinking about how to do scenario planning, how to build a value proposition, what your product should look like, please get in touch. We will be sending out the presentation materials, a recording of this webinar after the webinar finishes, and we'd be happy to talk about any piece of it. So thank you for joining today, and we look forward to hearing from you.